What is the SaaS pricing extinction event, and are you already seeing this happen?
AI, from an output point of view, is incredible. The value exchange has shifted completely, right? We're talking about category collapse here.
What's the most important metrics PE boards should be measuring right now?
Private equity will always value repeatable, scalable cash flow. If you can stitch together that with your code, this is why we think that data set that we're going to build and augment isn't going to be replicable by someone else. That will give you revenue like conviction over the next 3 or 5 years.
Private equity, they've got billions in SaaS platforms now. Are those platforms becoming worthless?
According to Gartner, 72% of SaaS companies will be forced to restructuring of their pricing model by 2027. And if we have a look at Salesforce, Workday, Monday.com, they all kind of struggling at the moment in terms of the stock prices. All because the pricing model is structurally slightly misaligned with AI. So how to price your SaaS in the age of AI? Today, we're speaking to Fessal Rahman from the Access Group, who partners with companies such as HG Capital and works across portfolio companies, redesigning the commercial engines of SaaS businesses from the inside to align them with AI reality. Okay, Fessal, fantastic to have you on Building Great Tech. Thanks so much for joining us. What is the SaaS pricing extinction event, and are you already seeing this happen?
Yeah, I think we're actually tackling a really hard truth, I think, at the moment happening in AI. I think that's getting a little bit glossed over by the code of AI, maybe a little bit from the tech point of view. And one of the things that we always say to a lot of our advisors, a lot of our partners that we work with, whether it's the value creation part or the private equity part, is it's cash flow over code, right? So let me unpack that a little bit. I think you are already seeing, an immense impact of AI, whether that's delivering 10x, 100x productivity gains, but that doesn't necessarily automatically capture into value, right? So we've basically ended up with a lot of vendors with an existing pricing model, a very successful pricing model, might I add. When you think about SaaS, it was a pretty much perfect model, right? Upfront, you have some build costs. It's near marginal cost from an incremental user point of view. Every additional user comes in, gets the value and incredible, revenue point of view, and then the margin sort of starts flowing very, very effectively. AI blows that apart, right? Every incremental user has cost, so it's just not the same model. And a lot of the companies that we're seeing, and the impact that we had earlier in this year, when you think about the SaaS apocalypse, almost 300 billion getting wiped off, was fundamentally not because we were having a dig at the AI companies or how you're embedding AI within your platform or your product. It was fundamentally your pricing model wasn't going to scale, right? So yes, AI from an output point of view is incredible. And I always sort of put it into, it's probably putting it completely in the inverse, right? You think from a product and a vendor point of view versus a customer point of view, the value exchange has shifted completely, right? Customers are getting 100x, let's say, in return. The product companies, same model, I'm charging you, let's say, assume it's on a seat basis, for example, it's the same model. So that's where we're seeing a massive value exchange, I think, exposure.
Yeah, you said user-based pricing is the laziest version of pricing. What's wrong with it?
Yeah, well, when you think about, we can give a really good example. When you think about someone like, I think you mentioned at the top of your show, a Salesforce. Right, let's think about Salesforce as an organization, right? So fundamentally, the CRM construct, you log it, you track it, you report it. It's predicated on humans creating data. That's fundamentally the value exchange, right? So you have one human, it goes to 3, it goes to 4, it goes to 5. Does that really scale with your value equation? I would argue not. Every user will be doing slightly different roles, slightly different value add initiatives, etc. Step forward into the AI world, right, where you have agents creating, updating all that data autonomously, no human touch, no seat required. So you think about the product in terms of Salesforce, Agentforce is a good entry into that model. Yet the value exchange, because it's still predicated on seats, it's simply it was lazy in the SaaS world. In all honesty, I think that we should have really pivoted a little bit more into that hybrid model. And 2/3 of the organizations in SaaS were sort of stuck, whether it's users, whether it's sites or per rooms, on that sort of firmographic model. They didn't really pivot, right? And now all of a sudden, this existential threat with AI is coming, where it's fundamentally great product, great AI value exchange in terms of automation of workflows, autonomous agents coming into play. We don't see any benefit in terms of the P&L.
Right. And also on top of that, obviously, you will have to, you would potentially have less user using that platform, right? Because if previously, let's say you had 10 seats, 10 users from a company would access, let's say, Salesforce, but let's say they now introduce some AI solutions inside of the platform and only 5 people is required to do the same job as previously 10 would, right?
Exactly.
So that also creates creates this problem with the seat pricing.
It's completely the right way to frame it as well, right? Where we're talking just AI, but let's put in the macro environment on top. Our companies, traditionally in terms of the 80-20 rule, are they growing or are they in effect becoming more lean or becoming more efficient? We're probably seeing the latter come into play. So even if we park to AI, in terms of organizations are really trying to drive a lot more long-term predictable profitability, and a lot of that comes through efficiency, we would have seen this impact on the firmographics. The seats is a great example. We work a lot with clients in hospitality, for example. A lot of macro pressures coming in hospitality. Are we seeing restaurateurs saying we're looking at our second, at our third restaurant, or are they saying we're trying to get really efficient within the compounds that we have today? And we've got 30 people resource today, but we're trying to get that down to 25. How can technology enable us? And then that puts us obviously completely inverse in terms of current pricing models. Mm-hmm. You put AI on top of that, it's like a steroid, right? Like that we've never seen before.
Yeah, it's like double trouble almost with this with the AI. Hey guys, we're really hoping that you're enjoying this episode so far. And if you are, please like, subscribe, and follow. And if you really want to know more about who we are and what we do, go to buildinggreattech.com. Now let's go back to the episode.
Because you were saying that the SaaS was actually quite a lazy model anyway. How would you think that probably should have developed before we've got into the complexities of AI?
Absolutely. We could let's think about a classic AI product, right? Where let's pick on a product which is probably close to all of us, something like a marketing technology solution, mm-hmm. where effectively it's lead generation, it's engagement. You're trying to drive a little bit of loyalty out, and you have customers sitting on it's a per user seat. Do you have a contract database where you're going out to 100,000 customers, global organization going out to 5 million customers, right? Your reach is completely different in terms of scale, yet you're still charging on a user basis, right? Why not have something which is a little bit more hybrid in place, which is saying we understand the firmographics is important because it's still predicated on human interaction. However, the reach in terms of you're actually going to be using a channel, let's assume it's a classic email channel, you're sending 5 million emails versus 1 million. Do you really want to be charging that same model to the customer who's going to be sending out 1 million emails, in theory, get a better conversion rate? Their bottom line, they could potentially convert, 10, 20x. The larger customers could be converting, 300x. So how do you then start segmenting your customers and maybe tie it to not necessarily just access to the product, which is the classic sort of SaaS, you pay for access, but actually it's based on access and breadth of use, breadth of value exchange, right? Yeah. And I think that's where some SaaS companies, I think we saw move into this sort of base fee versus plus there's a little bit of sort of consumption like you mentioned, and we saw those companies growing 20-30% higher than companies that were just predicated on a very sort of fixed simple equation, right? Simple to explain, predictability for the customer, yet you sort of limit a lot of your growth because some customers are going to be getting incredible value exchange versus others which might be getting bare minimum.
Yeah, very interesting. And that is dependent on your understanding of the customer, right?
100%. And I like to use an accounting term a lot with the internal team sometimes, KYC, right? Know your customer.
Yeah.
And for me, when you think about questions are going to come up around how do you think about these characteristics? It's first and foremost, every customer's value exchange is different, right? And I'm not necessarily saying you have 100,000 customers, you have to think at a customer level, but certainly at a cohort level, you could have 10 cohorts, maybe 10, 20 cohorts. How would you want to explain that? both from a retention play as well. You really want to explain at your quarterly QBRs, business reviews with your customers, this is the value exchange that we're delivering, so that retention play becomes almost BAU. It's just going to happen because obviously the value's been delivered and recognized throughout that journey. But at the same time, without that segmentation, you always see, if you think about it, you're probably serving 20% of your customers in reality, which probably fit that model. The other 80% are probably on either side, right? Either they're getting some sort of value reinforcement we need to do, or their value exchange is incredible. And there's a reason, right? Some of these customers stay for 10, 12, 15, 20 years even. It's because they see that. They see this as an incredible reality for us, where we as the vendor are probably getting less value as the customer. So, and it's a great model for them, but it's like for us, it's how do we balance that in a way which is scalable, whilst it's still repeatable and still preserve some of that customer lifetime value.
Nice. Yeah. And if we take into account, let's say Figma, right? So Figma for years had the same kind of pricing per seat, I think maybe around $200. And recently they've introduced AI within the platform. I think some of the AI they use I think is based on Nano Banana, so generation of the images. And they haven't really changed the price for the seats. And I'm thinking, how can they afford this, right? So how is it going to? It probably become at some point not really sort of great pricing model for them. But my question to you is, how do we actually price in this space when it's almost like hybrid even model, right? So it's still per seat, but also it adds on top of that the usage of AI.
Yeah, it's a really interesting question, because you probably heard in a classic sort of SaaS environment, the EBITDA levels, when we're operating at 60-70%, we're always thinking that's not enough. It should really be above the 80% threshold if you really want to get into top quadrant performance. You now start layering in AI in terms of, as we mentioned, every interaction, every transaction, workflow, potential development carries some inherent additional costs. And those margins are now coming down, towards that 40-50% mark, by the way. And you think about predictable cash flow, that's going to impact your cash flow. Cash flow is directly connected to your valuation. When we think about customers getting these 20, 30, 40, 50x on their revenue in terms of valuations, it's fundamentally because they see this every time a new customer comes on board, and that growth and that velocity, it's 80% margin banked. All of a sudden, the dynamics change completely. So the likes of Figma is a really, really interesting example, because I think their sort of valuation cycle is really going to shift. With Claude, of course, releasing some of its latest code around design, etc. It's fundamentally saying you can do all of that activity, and all we're going to charge you is infrastructure costs, right? Pennies to the pound. And now all of a sudden you've got Figma saying, got this model which is completely detached in terms of how we price. We just think a flat rate is good enough with a little bit of growth. But surely we should think about the three characteristics around what AI monetization looks like going forward, around that value creation, right? What's the outcome that we're pricing going forward? What's that outcome worth to our customers? Can we measure it? Can we measure it in the way that we can measure it as an organization? But at the same time, we're sharing that value communication with our customers in terms of, this is how you're using your products, our products. This is the value exchange. Secondly, it comes with scaling that usage, right? And I think you mentioned it, Simon, users use the product in very, very different ways, right? So whilst you yourself might be using a product at 20% of the capacity, and the pricing model reflects that, I think that's great. We don't mind having a lot of Simons in that organization. Anastasija might be really flexing and getting 300% value, 300% usage out of that product. And all of a sudden, I'm looking at my value creation and thinking, I'm not preserving my margin anymore, right? And that's because the efficiency in the architecture doesn't exist, because it doesn't scale by looking at Simon. It doesn't look at Anastasija in terms of the usage patterns. And that's one of the pricing tiers. I would say you need to reflect that in the pricing tiers, right? Where you have these different types of users potentially, but then that hybrid part is how is Simon using it and how is Anastasija using it? How can I get a fair share of that, right? And then the third part is, that's all going to be really, really incredibly important for us to be able to capture and support our cash flow and support that repeatable, predictable cash flow, because that's fundamentally the valuation cycle, right? It's the conversation we're having constantly with our customers, with some of our vendors, with some of our partners and teams on the value creation team. It's AI in itself being intelligent, AI in itself driving incredible efficiency and doing incredible work from a technology background doesn't make it valuable. It's the monetization model that is stitched around it, it's embedded around it, that shows us that value, A, it's now valuable, and B, you can repeat that activity, you can scale that activity, not just from a growth point of view, but also from a different persona, if you like, of customers that are using it. It's like that's the value layer. And that's where we're seeing companies that you've probably heard of, like Harvey AI, who've, I believe their valuation based on all of their AI capability and AI embedded pricing models is on a crazy curve at the moment. It's like, where is that? We're still trying to find out exactly where that tension is. But you're seeing the companies that are doing this in a really, really positive and right way. And they're obviously seeing the benefits, right? Not only from a revenue point of view, but valuation obviously drives investment.
Have you got examples of companies that you're working with that have kind of implemented these pricing models that are a bit more,
user-based?
Sort of AI first, if you like.
Yeah, yes, exactly. That's what I'm trying to say.
Obviously, other than giving ourselves a plug at the Access Group, where the technology is obviously, the velocity of improvement in terms of embedding AI into our platform, stitching the monetization around it as well. We're seeing a little bit of activity. So very, very recently, I think I had an exchange with Salesforce and some of their leadership team around their model fundamentally being completely disconnected. So I think that this is their third model in the last 12 months.
Wow.
So clearly they're having a little bit of difficulty around value capture at the moment. And you may have heard that recently they've just come out with a phrase fundamentally that all of the Salesforce ecosystem is now headless. Right? So it's a completely headless environment. It's basically the data is obviously the unique aspect. We have unique data now. And what we'll have is agents on top of that data, accessing data from one spectrum to the other. And it completely disappears in terms of that user-based model that Salesforce is so far, generally, 40 billion recurring revenue organization built on user base. They tried some strange things around, flex credits and stuff, which is, $2 a flex credit, again, giving you certain actions. And now they're coming up with a completely different mechanism, which says, actually, if you think about the three foundational layers of AI, the very first one, obviously, is that data layer. It's like, how do we monetize the data layer? And we can make ourselves headless. So, you can go into that environment now and just ask it questions. Tell me my top 10 customers who are coming up for renewal next quarter. That's the environment they want to create. You're not necessarily asking that question. Maybe an agent's asking that question and giving you the output. So it's completely flipped it on its head in terms of a company which is trying to, stay relevant, I would say, in this day and age.
And do you think that it's easier for companies who just kind of like becoming important now and they were like from the start AI first versus the companies that were like older version of SaaS and now trying to implement that AI?
Yeah, I always find there's a little bit of when you think about AI, when you think about technology debt, technology baggage, if you like, monetization baggage, and it's always there's always more considerations and steps when you're having to migrate a model, especially when you've got organizations, in the billions of recurring revenue, hundreds of thousands of customers. You're now migrating that customer user base onto a new model, and that migration obviously carries a lot of inherent risk because most likely you're doing that for one reason, right? You think there's more value to capture. So most of your clients aren't going to be getting a better deal, let's say. They're probably going to have to end up paying a fairer share. So there's always inherent risk in that model versus an AI native company, which can start the right way. But what we're seeing today, in all honesty, if you think about those sort of three layers, what I was going to mention around the AI sort of capability, where you've got the data fundamentally layer, you've got the algorithm layer, which then is like, how do we use our data so effectively to add value? And then you've got the monetization layer. That monetization layer, we're seeing, I would say 80 to 90% of companies, even today, i.e. the AI native companies that have emerged in the last sort of 12 to 18 months, they're not thinking about that. They've sort of stitched together a model which they look in the market and think, firmographic based, maybe we'll add a little bit of consumption, or at worst, they simply do something lazy and say, okay, it's costing me X, Y, Z from Claude. I'll put 30% margin on that. And there's no connection with the value delivered to what they're doing. And I think they'll end up with that age debt problem very, very quick. Like within the next 12 months, if they grow that organization, they're going to have to pivot again to say, how do you actually capture more value?
Yeah, and that's also another huge risk. So if you've got companies building on these platforms, Claude, that they are like dependent on whatever Claude is charging, right? So when eventually they're going to start pushing the prices up, which we have already seen a bit anyway, that company is that's just going to crush their ability to charge? Or do they just then push that onto the end?
Exactly. Or maintain their current, EBITDA levels, for example, their current cash flow levels, because it's not in their control, right? Which is probably one of the worst things any organization wants. And Claude's a really good example that you've picked up on in terms of their sort of monetization scat. I mean, their pricing is very off the sea. It's not very transparent. First and foremost, so they sort of they tell you how how you're utilizing some of their tokens, and then that algorithm in the back end is telling you what it's costing you, and whether it's costing you 100% off their pricing model or they're giving you a 90% discount because it's sitting in cash. You have no idea. You don't influence what sits in cash. So even your pricing model is predicated on what someone like a Claude Anthropic sort of pricing model is providing you. It's actually quite difficult to follow. Let alone then translate all of that noise into your customer's pricing model, or worse, which we've seen at the same time, is where your cost of doing business is just literally passed through to a customer, which is incredible, right? What are we going to put on building rent next or something as well onto a customer's invoice? This is your share of our cost structure, because that's fundamentally what AI costs will be. And then your last point around, they're about to release, Mythos, right? Their next engine. It's even when you think about now they're going to end up with these 4 engines with it's different scaling of pricing. How much control do you actually have in terms of which model is used, right? So it's like it's not easy, but and that's why what we always say is when you think about infrastructure costs alone, and you detach it from the outcome, you're going to be in a world of pain fundamentally, because the difference between an infrastructure and an outcome isn't just its 10x. We've seen outcomes where it's getting it's 6p to deliver, and the value to our customers in excess of £1,000. Like, how do you capture some of that? If you're so heavily focused on your cost and thinking, well, just add a little bit of money on the cost, there's a huge bit of white space. And to your point, Anastasija, the longer you leave that, the harder it will be to get new customers on board, and then your existing customers. Nobody wants a check saying it was costing you $20,000 annually to saying now it's going to cost you $250,000 annually. Nobody will accept that, and they're going to have to do that on a journey very slowly. So that all of that value equation, you're effectively spending a lot of resources now capturing share, which you should have already captured on day one. So when you're thinking about your code, I always say from a technology point of view, when you're thinking about the product, yes, we want to think about code, think about cash flow. Like, what are you doing this for, and how are you going to manage that in a repeatable and predictable way?
What's your take on, say, private equity that have got billions in SaaS platforms now since like 2021? Are those platforms becoming worthless?
It's I write a little bit about this, by the way, in terms of some of these segments that are, from a capability point of view, that are becoming worthless. So I think very, very recently, I think you might have heard Thomas Bravo has effectively written off their 5.4 billion investment in Medallia, I believe it is. Written off, like completely. It's gone off their books.
Wow.
Completely. So not it's gone down from a 5.4 billion investment to 2.7 billion investment. Not that 50% has been wiped up. It's been written off their books. And whilst that's not necessarily directly connected to AI development and evolution, etc., it's definitely going to be happening where you think about some of these categories which are going to simply collapse. You look at companies like, I think ServiceNow very, very recently have had an incredible year where their revenues have gone up. This is an organization delivering, $10-13 billion of revenue a year. They've grown 20% in just 1 year alone, which is incredible at that size to continue that velocity and that volume of growth. Their share prices dropped in excess of 30%. Fundamentally, because when you think about ServiceNow, it's basically their value capture, their moat, if you like, is based on organization complexity, right? It monetizes from friction. Mm-hmm. AI removes that friction. An agentic layer resolves the issue, updates the asset register, etc., closes that loop before a human even looks at it. So all of a sudden, all of these things that you're stitching together as your moat from a ServiceNow point of view, you start thinking from a product point of view, as I do as an observer. has that cognitive like overhead just become obsolete? And it might not be obsolete today, but will it be obsolete in 6 months? And these are companies, these are companies worth 100 billion plus. These are not small fish, right? One of the reasons we saw $1 trillion wiped off earlier this year from the S&P 500 was this very question that you asked, Simon, which is fundamentally private equity companies are looking at, not forget about the next purchase they're making. It's a completely different valuation equation now. They're looking at their book of business and thinking, this 10, this 12, this 15x valuation that we ascribe to this repeatable business model in terms of the cash flow and the EBITDA, the levels continuously growing and coming in. We're talking about category collapse here, and we mentioned Salesforce, mentioned things like ServiceNow, but anything, I would say, any company which you would think has a cognitive overhead linked to a human, I think is going to be under duress. And anything that you should be, we're doing this on a personal level where we're looking at every single one of our products and thinking, how is a user using this product? And are we like reducing some of the workflows as automation's taking away, the prevalence of a UI? What's happening from a use? How are customers getting value from this product? And will that value still be here in 6 months' time, let alone 2 or 3 years, because of the pace and the development I think we're seeing from the sort of the giants in the AI world.
And go on.
No, you go for it.
And do you, when you look at the company, right, the SaaS company at the moment, do you are there any signs, that very high level signs, that this company is not going to survive and we need to just, kind of write it off? Is there anything that at the glance you can see straight away?
Yeah, I think 100%. I think, we mentioned some giants, but you think about any SaaS product, like a classic SaaS product, where it's all about that human cognitive overhead. I think they're under duress. Like if that is your moat, where you need that human to create that value, that you need that human to be in your product or your platform environment to do things, that product is under duress, because once that becomes autonomous, you have to ask yourself, back to those, sort of 3 key AI principles, right? Do I have that data environment, which is unique to me? Like, it's one of the first foundational questions. If I've got a data environment, which everybody else can use as well, where's my moat? Like, what is my unique advantage in that? If everybody else has got the same data environment, think about the LLMs that, the likes of OpenAI and Claude obviously are building out. If everybody's using the same LLM, there's no differentiation, right? You're going to have a problem. You're going to have to create that differentiation. Differentiation being longevity has been a phrase for decades. I think that's even more profound going forward. So all of those companies, I find, if that data layer isn't unique to you, and I think we're seeing that with Salesforce, where Salesforce are saying fundamentally we've got hundreds of thousands of customers' data sitting, sales, very, very close customer, very sort of top line revenue generating quality data sitting here, unique to us. Nobody else has got that data in that structure. We got to make that headless really, really quickly. That is our moat going forward. Companies who are saying, well, we're using the LLM data from the likes of OpenAI or Anthropic. Well, guys, you've got people sitting in their garage. They can do that themselves. They don't need a 500-person organization to deliver that going forward. Mm-hmm. They're all the companies that we're going to see start getting a little bit of trouble. And the algorithm, obviously, which sits on that data and converts that data, yes, that's important to an extent. But algorithms, again, a little bit like AI being intelligent, that's not going to drive valuations and how valuable your company is, because we always have to think about cost of change, cost of some new incumbent coming in and doing the same thing. And if you're using these sort of standard open source or standard sort of models, etc., well, so can everyone else.
So what you're saying is, if you are Harvey that is using very specific data, probably based on a lot of kind of legal documents and cases and trained on very specific, unique data, they're doing really well. But if you are creating just a platform that is using Claude or ChatGPT to give you answers for your legal questions, that's not going to survive, essentially.
Yeah, and you need both, right? In the legal profession, obviously you need, it's very much about precedent, public level data, but at the same time also your customer level data and how long you've had that data is valuable, because nobody else is going to have that level of information on it. So it's a little bit of both, and I say that with a little reservation, because obviously when Claude did their earlier release, they released a lot of capability in that legal area, which I think worried any tech company which is involved in that legal space, because if they're already doing document summarization, referencing, cases from prior stuff for, and charging you infrastructure costs for it, that's going to put a bit of burden on it. But I think the likes of Harvey, what they've done is they sort of embrace that and think, you know what, there's value there, but we've also got inherent value with our unique data set. And how do we combine that and then offer that to a customer, which then all of a sudden is very convenient, isn't it? As opposed to I am having to stitch that together myself, look at my data, stitch it with Claude's data. They're sort of saying, look, just come into our ecosystem. We've got data that we uniquely own. We'll augment that with data from outside reference, from a reference point of view, and we're producing incredible results for you.
When you come and start working with a new SaaS company, how do you even start, like, with changing the pricing model?
Yeah, I mean, that's a really, really good question, and I think Simon alluded to one aspect, which I think is one of the layers, which know your customer, know your market, and when we say that, we don't just mean where do you want to target. Don't just think about a very high addressable market, but no, really go down to that obtainable market level. Like, what's the market that you can obtain? Like, as a small company, you're not going to get Microsoft onto your customer list, even though you could potentially serve Microsoft with your capability. So be very, very specific on your who you're targeting, because that's going to effectively drive what market you're operating in, where you think you can get an unfair advantage in that market. The second thing, fundamentally, you can't move away from the technology. Like, I think that product interlock when it comes to monetization has always been an afterthought. So most of the engagements we come in, it's very rare. It's during my history, it's very rare where you're thinking from the infancy, from the ideation of what the product is going to do, how it's going to deliver, what it's going to value, and what's it doing and who for. And we're thinking about the monetization at the same time. It usually comes in, oh, we need to launch tomorrow. What do you think we should price this at? So it's usually very rare, maybe a very extreme example, but I've had a few of those where, the launch cycle's within a week. Do you think we could do something with the numbers? It's like, well, pick a number. Maybe it's a good number. Let's go test it in the market type approach. But we have to get really, really early on that. And then, you come back to, you keep that AI piece on it, right? Because I think the AI monetization model principles are really, really solid going forward. Because if we can start stitching, think about all of the cost to business. We've never passed that on to a customer directly before, right? That's, we don't say this is what Simon's wages are. This is the overheads on Simon. This is his building costs, his laptop costs. We're going to pass that on to you. We've never done that in the past. Why do we take the AI infrastructure costs and think, let's just pass that on to a customer? Because we need to preserve and protect ourselves and think that's okay. So, we need to sort of decouple that. We need to be completely aware, completely aligned in terms of how that cost is going to grow based on different types of activity. We think these classic target markets that we're going to go after, there's 3 or 4 or 5 types of personas within that. How do we think they're going to use that product? How do you think they're going to get value on that product? How much do you think, not just what they use and adopt, but how much of it they adopt on a sort of classical day, week, month point of view? Look at that really, really deeply. Then start understanding, what are all my cogs underneath that? What's this going to cost me? All of that's just noise, right? We need to know that, but it's a little bit like the BAU part. We need to know that. Then you really want to come to the outcome, because that's really going to aid your sales model as well. Like, you don't want to turn to a customer and say, we can do this really, really great stuff for you, faster. Okay, there's a little bit of efficiency gain. We understand that, but what's the outcome that you're delivering? Because you can really pin all of your GTM and your selling methodology onto that outcome, because that outcome is going to be very, very relatable. You sort of resonate with your customers, especially if you're targeting at a vertical level or at a specific firmographic level. So I always say you have to do all of that hard work, but then really focus on that outcome. And once you've identified that outcome with that, whether that's with a cohort of customers or within a particular segment or vertical, what's that worth to a customer, right? There's easy productivity gains that we can share, but more valuable than that is if we're being more productive, does that allow your employees to do something else, for example? That's good. So there's a cost benefit, but there's also an opportunity cost benefit. But really relay that cost in sort of exchange, if you like, to your customers. And you think about the legal profession that you mentioned. Their business, very legacy business, it's very, very straightforward, right? It's just legal hours. I spend 10 hours. I'm going to charge you a lot of money as a legal, depending on the grade that I'm at and the role grade. I'm spending an hour to do some sort of contract validation. That's £1,500 an hour. That's my rate. That's what I will charge my customer. Straight away, you can turn around and go, well, that gets done in a nanosecond. It's costing you 6p. Do we really want to be charging that customer 6p? It might cost us 6p. Let's put a bit of margin on it. Let's go crazy and charge them 12p. That customer's charging £1,500 and you're charging them 12p. Now take that level down from a sort of a legal profession point of view. There's going to be tasks within their diary, which they're not going to be like monotonous tasks. They just have to get it done. Someone has to get it done. It's like, how do you move away from those tasks, get it done at a really nice value exchange, and then put your guys and your team onto tasks which are more value add, where you can, it's 5 hours of work. You can charge, £20,000 for that. And that's that opportunity cost layer. So it's like, how do you understand those layers from a customer first, from a customer lens point of view? And then all of a sudden turning around and saying, well, we think that activity outcome, we're going to charge you £100 for that. So, there's a 15x ROI for you. And there's a nice place that we could start the negotiation potentially from, right? Because we think we understand your business, as opposed to just, having an arbitrary number. Of course, you have to also, you can't, external market factors, your competitive factors, but then you have to tie in how good your product is from a quality point of view and an output point of view. You have to have some sort of market benchmark, because you're going to have to prove yourself against other competitors. But I always think you have to sort of decouple it and be very, very specific with pricing, rather than just a generic, we'd be happy with £10 per action for that.
That makes sense. And how do you kind of understand the behavior to kind of decouple those things and then put a kind of value on the use of the product? What's the approach? Is it like you are looking at the market's standards? I forget what you mentioned then, but is there strategies that you would implement?
No, absolutely. I always say you always have to look at, if you're an existing organization, you always have to look at how your customers are using your own from an internal lens point of view, that data-driven mentality. Then you look at the market from a macro point of view. Where's that market pivoting? What are those things that are truly value add? And then, of course, the competitors in your actual space, because you're always going to get benchmarked against them, right? And nowadays, with the AI tools, etc., that benchmarking isn't really a lot of effort either. It's usually a couple of decent prompts, and all of a sudden you've got this great comparison table. And then at the same time, that also prompts you to make sure that when you're doing your pricing, keep it really, really simple, so that when it gets digested by obviously the AI agents, for example, it's in a really, really clean and clinical fashion, and it's not getting misinterpreted. Yeah, just like there's a lot of these factors that you got to take into account as well. But the market will pay what the market will pay. Is a phrase that I always use. It's like, we can tell you we want a 15x return, but if we think there's a product out there which is delivering half as good value, but it's 1/10 of the price, we have a disconnect. Like, we won't be able to afford keeping in business in that model. Our content, our sales teams, doesn't matter how good they are, they will not be able to translate. Well, they're half the price. They're 1/10 the price, but they're only half the product. The maths doesn't work. So we have to be really, really fair in that approach as well, and really look at other customers, other sort of competitors, and say, this is where we think their product stack is. This is how they get it done. Where can we add value? Can we add value because we think we have a really incredible UI, or we add value because actually there's no UI, it's headless, it's all agentic. You're just asking questions in some abstract fashion, which is very nice because it allows a lot of different users to get that value in one place. Security, credibility, and all of that. Do we add some component where we think we can effectively say, we're better than those guys, but not necessarily, 10 times better?
Do you think that the UI like that we see now in the kind of your standard SaaS platform is just going to completely disappear, and we'll be just chatting to AI bots?
Honestly, I think, you probably heard all the horror stories around AGI, ASI, and all sort of artificial sort of general intelligence, super intelligence, and predictions where they were here in 2030, I think was the last prediction I heard. Yeah. And then you had obviously Anthropic turn around and say, I think it's here. So it's like that speed and that velocity of that growth is incredible. And as I mentioned at the start, products which are focused firmly on that human cognitive level, I think are the ones that are in trouble. So if you're going to say, I've got an incredible UI, that's nice, but I still have to go into the UI. I still have to go and navigate that way and ask things, versus, to your point, an AI bot and say, hey, tell me when Simon's contract's up for renewal. And I'm getting an answer because it's unique data. I'm literally asking it a question. It's bringing that prompt up with the next best action. Or do I want to go and do that and spend 10, 20 minutes myself doing it? I think the natural evolution will be that you want to become more productive, and then you also want to become, actually, let's move away from that completely and let's put some automation into that place where if Simon is this category of individual, this level of NPS, happy customer using the product to a certain level, how do we build that into an autonomous renewal? I'm not even looking at Simon anymore. I'm actually focused on Anastasija because her NPS is really low. She might be at risk of churn. What are the things that we can do? So also from a focus point of view, it allows me to focus on different types of individuals and customers. And I think the UI is effectively going to become a barrier to that.
Interesting. So are you saying like that SaaS platforms will effectively become like a database and we just be using these AI agents
on top?
Yeah.
And I think that's where the value will be, right? I think if you think about an ecosystem, for example, where you think we've got a database of our customer data, and then we open up our platform where we can ingest third-party data into it. So, for example, you've got 5 vendors in your tech stack, and we are saying to you, we're one of your vendors with unique data. We know there's value with that. There's value with our algorithms. We've got a really good monetization model. But what we're going to do is we're going to open up our platform, and we're going to allow you to put your second vendor's data in there, your second vendors that you're using, which is maybe complementary to us. All of a sudden, you've got one AI agent sitting on top of all of that data, and you can just ask a question and not care whether it's coming from my company or your company. You, as a consumer, are just consuming data from your 3 or 4 vendors, which fundamentally, to your point, I think that data element, people sometimes move away from it, but if you take data and algorithms out, there is no AI. There's no potential for AI. The AI, the quality of AI, the quality of output and delivering your outcomes is basically predicated on the fact that you have that. And if you're that vendor who has that unique data, I think longevity is going to be with you as long as you build a monetization model that then is embedded within that model and of that value that you're delivering.
So the value there is not just like in the uniqueness of the data, but the quality of the data.
100%. The structure of the data, right? So you think about a lot of these organizations, including us and others, the investments that we're making, whether it's Databricks or whether it's Snowflakes, pick your poison. That's what they do, right? They take your data. There's a level of transformation of that data before they load it into their systems, very much structured, and then layering on your algorithms on that and parameters will basically give you good answers, as opposed to, I think we all have the experience of, Chat GPT in its first sort of instance where they're coming up with answers where you're thinking it's not the right answer. It's a crazy answer. You're prompting them and they're apologizing for giving you a bad answer, because it is a bad answer fundamentally because their data set wasn't refined or optimized to the level. And that's what you're fundamentally buying, right? Going forward, you're trusting us as an enterprise organization to say that, that security, that structure of data, that quality of data and the integrity of data and the ongoing hygiene is at a level where the value then of you as a user getting, or you as an agent is going to be not just, good enough, but at a really, really high level.
Yeah. And on the chat GTP example, the actual way in which you've programmed your algorithm, so you aren't just making up crap as much as possible. You kind of avoid that thing that happens with OpenAI quite a lot, where it will just kind of make stuff, because it's conversational, isn't it? That's how the model's been programmed to be a conversational LLM. But if you're going into the business B2B, it's going to be about quality assurance and making sure you're getting accurate results for whatever it is that you're looking at.
So do you think that only vertical and specialized SaaS will survive in the next couple of years?
I think to an extent, it's going to be a really interesting. I was going to say next few years, but I don't want to stick. It could be a really interesting next few months in terms of the development cycle and just the pace of development is crazy. The way you're kind of getting the emergence of these sort of super companies, aren't you? And Anthropic, people will obviously always look at those guys, OpenAI, sort of competing with each other. And then you've got obviously Elon Musk's AI organization trying to make a few moves. You can't really move away from, because everyone's going to have to reference those. Like they're not someone that you can just literally say, all of that LLM that you've invested absolutely hundreds of billions, literally, private equity money in building, and now we're obviously moving away from that training model and actually usage of that training model. You can't replicate that as an organization. We wouldn't be able to say we're going to build our own LLM and spend 100 billion on that. I mean, it's just not, from a value point of view, it's not the right thing to do. So we're always going to be referencing someone like an Anthropic, someone like an OpenAI. Now, fast forward into a few years, and I sort of put it akin a little bit into the Amazon story, where as an Amazon, as an organization, you and I can all create our marketplaces on Amazon and sell our products. Amazon will look at that and think, "Wow, Simon, your product is incredible. You're doing really, really well. Why don't we do that?"
Mm-hmm. Like the same as the supermarkets, right?
Exactly. It's like, we see it on AWS, by the way. AWS controls the transaction arrangement. You're transacting through AWS. They're seeing all your metadata. They're seeing all your usage patterns. They're all of a sudden, this is a great bit of technology. We think we'll develop some of that ourselves. And we've seen that. We've seen that from Amazon, repeatedly. And that literally is their business model, right? Where they're sort of saying, you and I can take the risk in terms of whether there's a product market fit, scale it to an extent. And if we see that volume, that velocity, we'll take some of that and develop it ourselves, with the resources that we have. I just can't see how Anthropic and OpenAI, and we're seeing them do it now, why would they not get into that model where they're just saying, you know what, Harvey AI, you're doing a great job, Harvey AI, but I think we can do all of that work ourselves. And going forward, and that's where the friction starts coming in with a lot of PE activities. When we're doing the commercial due diligence, all of a sudden it's not about, I think you mentioned it earlier, Simon, it's not about, they're doing 200 million revenue growing at X% CAGR. We can sort of bank on an EBITDA going forward and the cash flow of the next 2, 3, 4, 5 years. You sometimes have to look at it and think, is that category going to exist in 3 or 4, 5 years? Because even on an extreme cycle from a private equity or a venture capitalist, you're going to be looking at a 3 to 5 year cycle. 3 to 5 years in today's language is, it's going to make things really, really challenging. And I think we've seen a lot of M&A activity really fall off a cliff as a consequence, purely because of inactivity. It's like, how do we make a good commercial due diligence call on something. They've got a really good data set. They've got a really good algorithm. They've got a really good AI monetization model. But what stops someone else just stepping in and saying, we can do some of that?
Yeah. So what's the most important metrics PE boards should be kind of measuring right now?
I mean, and the classic measurement always from a value point of view, private equity will always value something like, repeatable, scalable cash flow. That is literally the valuation. If you can stitch together that with your code, with your moat, in terms of, this is what we're building, this is why we think we're unique, this is why we think that data set that we're going to build and augment over the next number of years isn't going to be replicable by someone else, that will absolutely aid, because that will give you revenue like conviction over the next 3 or 5 years. Like, someone can't just come in and just say, okay, we can just develop that in the next 6 months. That's not the way data works, right? Data is obviously augmented over a number of years. If you've got organizations where, we've, done an M&A with an organization which had the last 10 years of MarTech, consumer data, for example, you can't just replicate that. It's not that you've got to wait a number of years before you can replicate that quality of data. And they're the sort of barriers to entry, I think, all private equity companies are now looking at. Yes, the maths looks incredible. And if we were, rolled back to 2024, we would be signing this customer up at these sort of value principles. Now we're having to do further work and, really, really deep dive into these organizations and think, how long will this value principle, remain effectively? What's the scoring that we put on that? So that all of that technology, that coding, how your AI monetization obviously works with customers scaling their usage, different usage patterns, etc. The longevity of that, how long are we banking that they're going to remain, credible and differentiated to an extent?
Mm-hmm. Wow, it's a lot to take on, Faisal. Like, because we've worked in tech for last 17, 20 years, and now
Likewise.
suddenly everything's changing. It's like, woo, what should we even do?
Yeah, I was just you try and like plan things out in your head, and I'm thinking, wow, okay, so those guys, the bigger players with the data, they've got this moat. What does that mean for people at the other end of the spectrum? Because they also have the ability to just create stuff
Yeah,
that's useful. Like, what does that mean? Because actually they're then dependent on the LMM models.
I was gonna say on that, right? Because all of the vibe coding tools now saying, oh, you can build your own product, and this story about Monday.com, when I think I mentioned it to you before. I was watching interview with the founder, and he said that essentially nothing really has changed. They're making the same amount of money, but they obviously the stock exchange for them is like collapsing. That's really bad. And then so at the same time, people are saying, oh yeah, you can use the vibe coding and create whatever platform you want and start making money. But actually that's not really true, because from what you're saying, even if I come up with a really great idea and start like vibe coding something in base 44 or Lovable, it's just not going to be defensible in like a couple of years time anyway. Is that what's happening?
I mean, yeah, it's really interesting observation, but I think it's I think to an extent I would kind of agree, and then what I would add to that layer on is materiality. So if you as an individual were to build your version of Lovable, and let's say you've got about an organization of 2 or 3 people delivering 10 million ARR over the next 12, 18 months, 2 years, that's a really incredible business model when you think about earnings per employee and that development. Will that be attractive to the absolute super giants that we're probably are gonna emerge over the next 1 or 2 years? Maybe not. So there's probably a cliff in terms of where it becomes something that they want to absorb versus where it's just a little bit of noise. So I think there'll be a lot of that human like creativity, if you like, human centered creativity around AI. But I think as soon as it sort of scales and gets to a level where it becomes significant, I'm not 100% sure what that significant level is, whether is 100 million significant these days to these guys. These guys, you've got Anthropic's revenue profile where they haven't even touched their pricing model at the moment, and they're about to change it very, very soon, I think in the next couple of weeks.
Oh, really?
And they're moving over from per seat model into because they wanted to drive adoption, and boy, did they drive adoption for sure. Mm. And they're moving that into the consumption model where they're effectively every customer is probably going to pay anything from a factor of 5 to 20 more. X more. That's literally what's going to happen from their user model to their consumption model. But they've got that adoption, right? They've got 30 billion recurring revenue in a very short space of time with a completely crazy pricing model, which doesn't fit for, it's not fit for purpose, but it was fit for adoption.
Right.
So, I'd rather say, hey, use as much as Claude as you want for $20 a month. And, you're going crazy with it. And then they, pour in a few more tiers, $50, $100, $200, I believe it is. Great. They're going to be pivoting that to consumption based, and your $200 is not going to be $200 going forward.
It's
probably going to be
it's like
$3,000, $4,000, $5,000, and you're going to be so embedded in whether it's OpenAI or whether it's Anthropic as an example. You're going to be so embedded, you're not going to have a choice, and they know that. And this is the reason they've got £200 billion, $200 billion so far to generate 30 billion. Like the math sounds crazy, right? Here's 200 billion, Simon. And you've generated 30 billion in that year. It doesn't sound very healthy, does it? But they know that there's an inflection point coming where that AI monetization is going to catch up, and Claude is going to be, keep an eye on their revenue over the next 12 months. It's going to be absolutely crazy once they've embedded this, because they've got that stickiness, they've got that adoption. Reliance is the word I would use. I mean, we as an organization, as an example, could we just extract Claude code from our ongoing operations? I don't think we could. Don't tell Anthropic that, but I don't think we could.
Very smart psychology.
Yeah.
They basically like encourage people to create a habit, and hard to go back.
Not that we want to use the analogy with a drug, but it's probably the closest thing you can get to a good drug, if there is such a thing. That's got you hooked at a very, very low price, and now you just can't function. Whether it's your organization or as an individual, you just can't function without it.
Can I ask you, what do you think private equity are going to invest into, like, in the future then? If SaaS, as we know it, will cease to exist potentially and everything will become just a database and agents on top, what do you think private equity will be investing then? They're currently investing in SaaS.
Yeah, I mean, and they've been on a great run for SaaS, right? I've been in the environment for two decades, and they've been on an incredible run.
Yeah.
Like most private equity companies would openly admit, yeah, we've made our money in SaaS. So even if SaaS starts, the focus, if you like, starts moving away from SaaS, I think it's totally fair. right? We had the industrial evolution, which we missed collectively probably. We had the internet evolution, which we partially might have observed some of, and now this is the next big thing, and it's probably the next big thing, which is not built on any precedent either. So I just feel that private equity companies at the moment are really thinking about, we're seeing all this incredible, like really cool tech, really cool AI use cases. Everybody's doing something, in their code, they're creating something. But private equity companies are going to be very, very simple. As I mentioned, having something really, really intelligent from an AI point of view isn't valuable. Like, you need to prove that your monetization model works with your AI model now, and it scales, which I think is the other factor that we never had to worry about in the SaaS world. Invest good money, build it right once, and then the ongoing maintenance, if you like, it was relatively low, and it's just effectively, it's incredible levels of cash flow coming, very consistent. Build it once and then just really reap the rewards. That value equation now from a PE point of view is like, you can't build it once, because the velocity of change and the development is crazy. You think about an average procurement cycle of 12 to 18 months. Like, what's going to happen between signing a contract and renewing that contract, like in that middle of that space, like for you to stay relevant, for you to get retained at a customer level? I mean, the private equity companies are thinking the same thing. It's like, you have to prove to me that your AI monetization model on day one is fit for purpose, because we need to have somehow be able to predict, cash flow. It's going to scale. It's predictable. It's repeatable. All of those consequences. And in all honesty, in the old SaaS days, I don't think we should really think about it. That we weren't heavily invested in that. We were really heavily invested in getting our, target market. How do we get those first customers on board, and then obviously, like a snowball, build on that model. Yeah, we'll optimize the pricing, over the next couple of years. We'll optimize it on a few basis. That used to be a little bit of an afterthought. Like, the money will come, we'll shift it. Going forward, if you haven't got that monetization model stitched with your AI moat and your value story, private equity is simply going to say, yeah, we can see you've made money. It's a lagging indicator. We can't see what you're going to make going forward. So how can we put our hat in the ring and give you any sort of valuation?
Interesting. So you're thinking maybe in the future, private equity are not going to be investing in tech? Because, if you look at venture capital, for instance, I think they're all going absolutely crazy about AI and investing in the AI companies. But obviously, it's a slightly different model than for PE. So do you think that majority of investments will going to from VC space rather than PE space?
I still think the PE space is going to be really, really relevant and really, really impactful in here. But I think ask yourself two questions in that space. First and foremost, if you're looking at that sort of valuations that we're getting, some of these are getting sort of very fluid at the moment. How can you benchmark yourself on that valuation exchange, if you like, if you haven't got all the prerequisites? So you haven't got that AI tech, you haven't got that uniqueness about whether it's your data, your algorithms, etc., and you haven't already stitched an AI monetization, and then expect a valuation of 50x, even if you're in the right space, the right tech. So I think the demand will be different. So I think from a PE point of view, they'll demand that you have all your ducks in a row if you think you can get that, and obviously evidence-based value return, right? Then you can get that. Otherwise, I think you're going to basically see a hit on valuations, which says, we think we can help you get there, but you're not there today, which means you're not going to get that valuation that you're looking at in the market and thinking someone similar has just got a 20, 30. Your valuation is going to be a fraction of that, because there's a time to value that we have to now help you deliver. And I think that's what we're seeing more and more scrutiny in. At the moment, I think you're seeing a lot more hesitation. I think it's like there's more stalling of deals, because it's like there's further due diligence that's happening in terms of, question Simon asked about relevance going forward 1, 2, 3 years. At the same time, is the model built? How long is it going to take us to build that model out? How long is it going to take to get that evidence that this could be successful from a value capture point of view? So then there's a lot more questions than a sort of classic CDD we would have done, 2, 3, 4, 5 years ago. It's completely different now, and I think that's stalling everybody, because everybody's a little bit, what does good look like? And I think we're sort of building good at the moment as we sort of go along, because the development cycle are so quick. And the other thing that can leave a lot of people with this thought is, you think about all of these AI companies, part the sort of providers, the people who think they've got some incredible technology. Like, you want to stick to someone like a Salesforce, right? Agent Force is what they're putting there, and their headless mechanism is what they're putting their, effectively the future of their IP on now. What value has it delivered so far? Like, it's not new. Agent Force is not new. They've been marketing that for a substantial amount of time. Their share price has gone down 30%. They missed their quarter from a revenue point of view, which I don't think they've done for a lot of quarters. I mean, Salesforce was just renowned on just hitting their numbers every single quarter, relentless. They missed their number. So it's like, these AI companies are saying we've got AI products embedded, or that's our full story going forward. We're not actually seeing the value return at the moment.
If you had to, if you
outside of productivity,
say you had 10 million of your own money, like what would you be looking for if you were kind of going to invest in a SaaS company at the minute, or would you just not at all?
I certainly would. I mean, first and foremost, when you think about valuation, you sort of think, do you have the right sort of leadership team to sort of drive the change? Like, that's one of the top things that I would, because change is inevitable. Like, that's the one thing that we have to get comfortable with in this day and age. It doesn't matter what's worked in the past, and even if it's worked phenomenally well in the past, which it has for a lot of organizations, it's changing. The game's changing. The landscape's completely shifted. So if you haven't got the right team, that's one of the first things you'd be looking at. And then, we go back to that sort of moat equation. Your revenue is not your moat. Just because you've got 100,000 customers, that's not your moat. Your moat is really, what are they doing on your platform where they can't do it anywhere else? So that 10 million, like, if you think about the due diligence, would really be thinking, what is it that you've got which is unique from a data point of view and your algorithm point of view? What is super, super unique? Where I can't look around and think I can't find another 10 companies that are doing the same thing.
Yeah, and have you seen the DD process change recently? You said there's like a little bit more, it's a bit more hesitant in the market. So has that evolved just recently to try and get
what I'm hearing is that's the part which is causing a lot of the nervousness at the moment, because a lot of these DD processes haven't changed.
Right.
And where they are now a little bit more fluid, that change mechanism is now really trying to stitch together the AI narrative from a value point of view, the data algorithm narrative, and then the AI monetization narrative. They're really being more demanding on that last layer. That last layer just doesn't exist. We've never really looked at even pricing. If you think about just like very like pragmatically SaaS pricing models, we've never looked at it. We'll put a bit of optimal, we'll be able to get another 10% here, another 5% here. So when we think about future outlooks, etc., it's never been a deep dive. It's been very much light work on the pricing side.
Okay.
And then we can do the valuation, because the valuation just works. Even if everything is static, it's a really incredible return. So on the pricing side, we do a little bit of optimization. But what we now obviously see, and I'm hearing as well, there's a lot more demand in showing, like, prove out your AI monetization model works with your product, with your target market, with how your user base is evolving, how they're using it with agentic, etc. There's a lot more questions being asked, and that's where we're seeing a lot of, whether it's founder-led or just general organizations, a little bit behind the curve, where they're just saying, we haven't really thought about the AI monetization. So I think you're going to start seeing, I think, good for anyone involved in this space, by the way, from a career point of view. When you think about AI obviously taking your job, AI monetization, I feel over the next few years is going to be something which is going to just go crazy in terms of how do you stitch that product, that market, that customer journey together with something which you can actually, effectively put your money on.
So is there, like, in terms of, the due diligence piece, there's the commercial side, you have the tech piece. Are you saying you're seeing a bit of an AI piece come in there, or does that slot into tech, or actually it's not been placed anywhere? It's like coming up in both houses, the commercial side, the tech. I know also, am I right in thinking like maybe product isn't really a sort of unique piece on its own, and that kind of gets thrown into tech, and it's more around like the systems and the back end, rather than like, is it relevant for the customer? And am I right in thinking that? Or
I think you're on a really good track. So, one of the biggest things that, in any due diligence process we used to do is effectively stress test the product, right? To your point, the quality of the product, whether it's integration, whether it's security, just the overarching quality of the product. And if you scored really low on that, that would obviously impact your valuations, because it's like, how long will it take to fix? Right. Now, just park that thought for a while and think, okay, we think it's going to take you 3 years of development time to get that fixed based on your current resourcing, unless we do some investment there. Put that into the AI world and think, we'll get that done in 6 weeks. It's not even a consideration anymore. right? So first of all, we're like heavily invested in that area, thinking, wow, we can't sustain the value, the expectations, because there's 2 years of work to be done, blah blah. All of that's gone out the window. It's like all of that's like, actually we can get that done over the next few couple of cycles now. So that part of the DD is already becoming, product's not good enough. Great, we'll use that from a valuation point of view, but the fix is not 2 years. The fix is 6 weeks. Parked, done. Next thing, back to the classic argument. Why do you have a differentiated product? Why do you have a moat? And is that a moat for the next 1, 2, 5 years? And why? I think that's where it's even more heavily getting invested. And if you haven't got an AI story on top of that, which is agentic, which is saying that cognitive human part is getting moved away to AI bots, call it what you like, agentic. How long are you going to be able to sustain? There might still be some inherent value in that organization, but how long are you going to sustain it for?
Yeah.
And I think they're the considerations. I think they've always broadly been there, but now what they're stitching together, I think, is that third wheel, which is how do you make sure that your AI monetization maximizes, on day one? Because nowadays, how long is a piece of string from a company's life point of view in the AI world? I mean, you can't even put your hat on saying, this company's been around for 20 years. So what? It's like, literally, so what? You've had 20 years. So what? It's like, you think about the emergence of Netflix, what it did to Blockbuster. Blockbuster's revenue went on a managed decline over 10 years. They were doing really great revenue even 2 years before existence. Kodak's another one, right? They were incredible revenues up until then. Then 2 years down, they're bankrupt. It's like these companies, like your lifespan isn't predicated by what you've done in the past, which is a little bit more classical enterprise technology. You've been around, IBM. You think about some of those classic ones, they're still around doing stuff, but you just think the next evolution is going to really wipe out some of these companies because their relevance just won't be there anymore.
Wow.
Interesting.
Oh,
Fessal, one more question I have for you. So what are you the most excited about in the next 12 months?
I think the most excited, I honestly, genuinely feel the commercial inflection point, and probably something I'm quite passionate about myself, and that product approach. AI obviously is going to be something behind the scenes. I feel that's going to become the moat going forward, where actually now your commercial engine, your commercial monetization model isn't something that we have to think about going forward, isn't the exciting part. I actually think it's going to be one of those absolute Mandarin layers, right? Where you've got your product layer and your commercial layer hand in hand. And I think that should be really exciting for us, because I think what we're going to be doing a lot more of going forward is building right on day one and scaling organizations. And then the second thing, as someone who's just generally incredibly passionate about technology, it's wow, where are we headed? AGI, ASI, what's that impact going to be? It's going to really make every one of us think about, from a career point of view, where do we want to go with this? And, where do we latch on? So I think it's really exciting times to an extent, maybe that sort of point in time where actually, everything that I look at myself, think everything that I've done over the last 15 to 20 years, do I need to just delete 95% of that? That's quite exciting for me. It's learning something new rather than just the next 10 years being optimizing, doing similar things, but using your experience and scale. And now you're ending up becoming that sort of next entrant into the workforce, right? Where everything is you're open to everyone's opinion, open ears, etc. And to some people that's going to be exciting. It's probably what I would say. It's for me, it's not knowing 95% of what's happening in the next few years is quite an exciting place to be.
Very positive.
Yeah,
very positive. We like that.
Invigorating.
Yeah, exciting.
Yeah.
Fessal, you've been absolutely amazing. Thank you so much for joining us. I loved everything that you mentioned today.
Yeah.
So much great information for our listeners, and you have fantastic energy. So thank you very much for joining us today.
Pleasure. No, thanks for having me, guys. Very interactive, very great conversation, close to my heart.